Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I'll be your host today. And today I'm happy to be joined once again by Paul Robson, who leads our G10FX strategy team over in London to talk about all things currencies. This week, it's been a busy few weeks, Paul. Definitely happy to have you back to talk through some of these themes.
Yeah, it certainly has been an extremely busy start to the year. I keep going away on Friday, hoping the following week will be a little bit quieter, only to come in on Monday morning to find out that it's going to be another busy week, but it certainly makes the days go quickly. But thanks so much for the invite again to come and dissect a whole long list of things this week, I think.
Yeah, there are absolutely a lot of things going on. And frankly, some of them, as we record on Thursday morning here in the U.S., still feel outstanding. We're still waiting for a reciprocal tariff announcement from the U.S. president here. But I do want to start with something we talked about last week, Paul, which is the Bank of England decision. And you ran through that really nicely last week, talking about the vote count and the surprise there and the currency reaction. But over the last couple of days, we've had a chance to hear from various members of the MPC. Do any of those stand out to you? And how are you feeling about the Bank of England now, having had a bit of time for markets to maybe digest that surprise vote count?
Yeah, I think that the speakers that we had this week, which, as you say, were very timely, coming so quickly after the decision itself. And just to recap, we had that 7-2 vote in favour of cutting rates, but Catherine Mann, who had been the chief hawk on the committee, had moved over to the dovish side, so really quite a conversion. So we got to hear from her, we got to hear from the chief economist, we got to hear from another centrist member on the MPC. I think the key one-line takeaway is that I think they support our initial take that the underlying or the actual formal guidance and the forecast suggest that it wasn't the sort of dovish surprise that maybe the vote count would suggest. When we look at the Peel and also Green, I think they were very much in line with the centrist view of a cautious and gradual approach to monetary policy. I think they're a little bit worried about the persistence of inflation from a expected tick up in inflation at the beginning of the year. They just think the economy perhaps is not quite as efficient as it used to be. So very much in line with obviously how they voted. Listening to Catherine Mann, I mean, she also kept very similar to her sort of vote. And I think she's just a little bit more confident about that persistence of inflation. She notes the weakness in the data. She noted the weakness in the labour market. And she also mentioned that the inflation that we're getting in the UK isn't really domestically driven, and that's what the central bank can target. And she went on to over a number of pages and slides to justify that. It was a little bit of a more difficult speech, I think, to dissect, because right at the end, the second last paragraph, she then went on to say that her expectations for the neutral rate here in the UK, that the Bank of England had surveyed back in 2018, somewhere between 3 or 3.5% for the landing zone for monetary policy. She was at the upper end of that range, and we're only at 4.5. It doesn't take much to get us down to that level. So, being that sort of activist monetary policy person, it doesn't feel like she's going to vote for a series of 50 basis points. And I think that was the key takeaway. In terms of our house view, we still think 4%. Rather than sort of markets 3.75% is the right landing zone for monetary policy. But if the labour market was to weaken and the economy to weaken a little bit more quickly, then perhaps the Bank of England can cut rates a little bit more quickly. But there wasn't a huge amount in there that changed our thinking, to be honest.
Yeah, I think that's a nice segue into my next question, because the other thing I wanted to ask you about as relates to the UK is some of the economic data that we got this morning as we record on Thursday. It looks like, in particular, GDP number maybe a touch better than expected for the fourth quarter. What's your takeaway on some of these numbers as we think about those growth risks that are feeding so clearly into both market and our own expectations for the Bank of England?
Yeah, so as you say, a bit of rare positive news. The tone of the data have been pretty downbeat. We had some stronger than expected data the first half of last year, but since then, the data have been gradually softening. There was a little bit of discussion in the media if we would be falling into a technical recession. But as you say, they were a little bit better than expected, particularly in December, 0.4%. So the data can be quite volatile month to month. So we look at the quarter on quarter, and there the economy grew by 0.1%. It was expected to fall by a tenth, so 0.2 difference, not a game changer, but I think it leans against some of the negative narrative, and it'll be interesting to see how we obviously go into the beginning of the year. But the economy does seem to be slowing, labour market slowing. And for me, there's two ways to look at this data when we think about currencies. The first one is the market narrative about stagflation risks in the UK. I talk about this as being important in terms of the current account deficit, overseas investor appetite to buy UK assets to fund that deficit. If we get a little bit stronger growth, or that stagflation sentiment shifts a little bit, that can be positive for sterling. So follow the data, stronger data, a little bit supportive. The other angle, I think, and this could be more important, what we saw over the last couple of weeks is this building idea that the economy is underperforming government projections. And here in the UK, we have the Office for Budget Responsibility, and they have a growth forecast. And if growth is weaker, you get higher cyclical government spending and you get less tax receipts. You have a problem with the budget deficit. The government has to borrow more, and they don't have a huge amount of wiggle room regarding their economic projections, their borrowing numbers relative to their fiscal rule. So if we get a little bit of stronger growth, it just alleviates some of the issues for the government. We have a spring statement coming in March, and it might just take the pressure. Why is this important for the currency? As we went through last week, sterling is the release valve for worries about fiscal policy. Sterling goes down when we worry about it. I think we're in a sweet spot at the moment where more borrowing helps sterling. But if we get to a too high a level of long-term yields in the UK, people start to worry about doom loops again, and sterling falls. So net, a small positive, but I don't think it's a complete game changer.
I mentioned this at the outset, Paul, but we're still waiting for some big announcements from the U.S. president on tariffs. So I don't want to go too deep into the tariff discussion here, as some of our listeners, by the time you hear this, you might know more about what Trump might be planning this afternoon than we do as we record. But we do know that the UK actually did see its first set of U.S. tariff implementation in the form of steel and aluminium tariffs. I mean, we haven't had the implementation yet, but they are part of this. What are your early thoughts about tariff risk, and specifically the UK, and how the UK's position is relative to maybe some of its peers as we think about these trade risks?
Yeah, I think the trade risks are probably less for the UK than they are on some other economies where trade is more important, or they run larger trade surpluses with the US. I don't think the UK is in the crosshairs, at least initially. You talked about, obviously, steel and aluminium. That was a blanket tariff that's going to come in later. It was quite interesting. I was reading this article about how the UK steel exports to the US are actually recycled steel that go into arc furnaces. So by putting a tariff on imports from the UK, you're raising the costs for US steel of domestic production. So there's probably a discussion to have, and that's as you've been talking about all the way through, this idea that's about giving time for negotiations, delayed tariffs, and that's something that I'd like to explore with you in a few minutes. So still no change there. I still don't think we're going to be here in the UK front and centre of tariff risk. It doesn't mean that it's completely riskless, because there are a lot of things the UK does in terms of trade policy where US companies would like greater access or less restrictions. And we saw this when under Donald Trump 1.0, when there was talk about a great free trade agreement between the United Kingdom and the US, and then reality hit that on both sides, perhaps it was less comfortable. Maybe the UK wasn't prepared to give that concession. So there's always a risk of a tweet on a Sunday evening. We come in on Monday morning and sterling has reacted, and we'll definitely be watching that. But yeah, no necessarily special treatment for the UK, because we don't really need special treatment. So we'll see how we go.
I did want to expand the focus a little bit here and talk a little bit about the remainder of Europe. I mean, we've had just a lot going on in Europe with, there's developments both happened and upcoming in German and French politics. We've also had the shifting expectations around what happens with Ukraine and Russia, the war there, given Trump pushing a peace plan. we're seeing some signs as we record on Thursday morning that we do have a bit of upside in a lot of non-dollar currencies, euro included. Just curious about how you're thinking about these, trying to fit these political risks into this picture.
Yeah, there seems to be a lot more cross currents, doesn't there, when it comes to the euro and the European Union and the euro area, as your sort of question suggests. I think it's a bigger deal for the European Union, the euro area, because the euro area runs a bigger trade surplus with the United States, and obviously a bigger target for with the new Trump administration. So we'll wait and see. I think one of the interesting things to concentrate on is the size of trading blocks and countries. So initially, Trump went after some of the smaller countries like Colombia, and then there you get concessions. Europe and China are larger trading entities, and the European Union has a history of going really quite hard at retaliating against tariffs that they don't think are suitable in terms of trade policy. So we'll watch that. But the thing I really like the way you've been talking about it in our internal sort of discussions about what does Donald Trump want to get from Europe in terms of trade. Of course, getting the trade deficit down, US trade deficit, Europe down. I think that's obviously a fundamental part of it, and also getting production in the US. But the other interesting angle that you've made about is it about trying to get concessions out of Europe over Russia, Ukraine, and that was some of the more important information this week, the chances of a ceasefire, a peace deal, who's going to pay, who's going to do the security. And the US has shifted quite dramatically. And this is all part of the deal, the art of the deal, of trying to get Europe to agree for this peace deal in Russia, Ukraine, which then Donald Trump can take credit for bringing peace to Europe. In terms of the euro, I don't think we should get too carried away on the prospects of the euro going higher on a peace deal, because I don't think we're going back to importing lots of cheap Russian energy. That sort of horse is bolted, if you like, and I think it's going to get that very difficult to get it back into the stable. And I also think that getting a peace deal in Ukraine comes with significant costs, and European growth is weak, budget deficits already large, and there's lots of wants on the public purse. So maybe a small upside, and as you say, euro dollar looks a little bit low on our valuation models, and we think that it can go a little bit higher, I think, on this news while we wait to see how tariffs are negotiated. In terms of tariffs, I mean, all these tariffs and news are stemming from the US. So we've had tariffs, we've had economic data, we've got international geopolitical shifts. So I was just wondering how you're seeing the data and the mix between the tariffs and international policy, and what that means for the dollar.
Yeah, so as you mentioned, there has just been a lot going on. And so maybe starting with international developments, and you sort of mentioned the possibility of markets getting maybe a bit more excited about the possibility of a ceasefire in Ukraine and what that might mean in terms of positive growth. Like you said, I think we agree that we don't want to take that maybe too far. But I think as we're thinking about Trump risks and how the market's interpreting Trump risks, the pre-inauguration period versus the post-inauguration period, I think it's clear that the market is trying to, or leaning into the optimistic direction when trying to price risks around Trump implementation, whether that be more recently some of the optimism about Russia and Ukraine, as you mentioned, but also just the overall arc of the trade negotiations, that the general gist of the market reaction has been the bark is worse than his bite on trade implementation. Now, of course, we did get a very significant escalation on China with the 10% tariff on all imports was implemented. So it's not like Trump has just delayed everything, but the market has got a very clear sense, or at least has this strong feeling, that Trump's initial salvos are all intended to be negotiating tactics, and that he's going to be giving time for partners, especially allies, to work their way out of the worst of the trade war. And I think also the markets have identified, or at least have some confidence, that the equity markets here in the US is going to provide some checks and balances on these policies, that if the equity markets react in a negative direction, that's going to force the administration to pivot to a friendlier direction. So maybe some circular logic there, that it takes a risk off reaction to bring a risk on, but it's almost like the equity market is the trade war bazooka that it doesn't need to fire, as long as that market has a sense that lower equity markets could stop the president from moving more aggressively, moving as quickly as he is threatening. As you mentioned, Paul, we are seeing that play out in markets where you've seen the dollar has come off of its highs. But this is also against economic data. And since we last spoke, we've gotten a lot of important data and some, I would say, somewhat surprising reactions in those cases. One of the things that we've been watching or worried about, really since the inflation number, the CPI we got last month, was for this possibility of a snapback in inflation because of how turn of the year seasonals have tended to boost services prices in particular in the early months of the new year. This has been really a post-pandemic phenomenon where you get resetting of contracts is very common in December to January. And so that's a timing when cost increases get pushed through to consumers. And so the CPI has shown some pretty nasty snapbacks in January numbers that get released in mid-February. So we were eyeing up this move lower in the dollar, especially against dollar yen, because that's one that's so sensitive to interest rates and sensitive to the cycle, and wondering if the CPI coming in firm was something that could maybe lead to a bit of a pause here, maybe a retracement of that move, maybe a bit of a pullback in the dollar. We did get that upward surprise in the CPI. The core CPI was stronger than expected. It actually almost rounded up to a 0.5% on the month-on-month. So not only above our own expectation, which we thought was on the high side of expectations, it was well above our expectation and well above the market consensus. But the dollar really didn't have the same reaction that we saw in rates markets. Certainly rates markets were off to the races in terms of pricing out expectations for future Fed cuts on that. But the dollar reaction was a lot more muted, and that maybe suggests that FX markets are more willing to trade on the back of other drivers, whether it be these changes in trade policy, these assumptions about the broader global growth picture that comes with shifting expectations around trade war or around these geopolitical risks. So we found that a very interesting wrinkle here that we did not see. Certainly dollar yen moved up on the CPI. Since then, we've gotten the PPI, which as they feed through to the PCE deflator is not as dramatic in terms of upside as the CPI was. And so we were worried this week heading into CPI that we would get a strong number and that could maybe arrest some of the dollar downside. We got that stronger inflation data, but we really didn't see that follow through stronger in the dollar. And maybe that reflects, Paul, something you've been saying, which is the dollar does look a touch overvalued still in some of our fair value metrics. And I think the market has generally been pricing towards U.S. exceptionalism, and dollar outperformance as a reflection of that has looked increasingly consensus here. And so the reactions that we've seen are maybe a sign that there's just not as much juice to squeeze in terms of U.S. economic data forcing greater optimism. And now with the market's price, the next cut from the Fed well into the end of the year, I think that might be playing out here in markets where other drivers are asserting themselves here while we have a Fed that looks pretty firmly on hold. So maybe we'll end it there. I think that's a great time to conclude the conversation. Paul, thanks very much for joining. I know we covered a lot of ground today, and we will see what happens next week as all of this is likely to change. And to our listeners, thanks very much for joining. If you enjoyed this podcast, please consider giving it a like and also subscribing to the channel so that you can get our content the moment it's released. Thank you very much.